price of US light crude oil hit a 14-month high on Wednesday as worries about what's happening in Egypt really come to the fore. Here to talk about the market implications is Ron William. Ron, thank you very much for coming in today.
Happy 4th of July greetings, Monica. I'm happy to be here.
Certainly, of course. Now, if we talk about, we're going to look at oil and look at some different charts, what's going on in the markets because of all this action in Egypt and obviously all of the concern. Now, traders are worried about the political turmoil, as it were, what impact it's going to have on the flows of oil in Egypt through the Suez Canal as well. So how is this affecting market sentiment? And it's obviously causing a little bit of jitters. From a technical point of view, what can you tell us?
All of the key word is risk premiums and whether or not the oil market starts to price that in before the actual event of the 30th of June, which was actually the protest movement, Tamarud, which is the translation for rebellion in Arabic. Before that happened, there was a trade set up in place on oil, West Texas oil, so we're looking here at the chart, which were hit around 99.01, failed, but then just before the protest was starting to nudge and break above that key level again at 99.01. So what we're seeing now is, of course, the market's moved much above that level, $99.01, but also 142. What's important is technically speaking, this is a price and time breakout. So in price terms, the levels that I mentioned are key, but in time duration, there's been an intermediate cycle, which I've been looking at for some time now, which was calling for a move roughly around the June 28th, plus or minus 2-3 days, nothing's exact, for something big to happen in the oil market. So it seems to be that the technical situation is leading or suggesting some of the event risk that might happen over the next few days.
Now, in terms of the risk, it's in terms of the prices of oil, they're kind of it's very different from the historic level, and we're sort of expecting a bit of a gap. We've got another chart here. What can you tell us about the historic volatility signals and what this should be telling traders at the moment?
Well, this is a very important chart, which I hope all the Dukascopy audience can look at over the days. This is giving you a big picture view of oil volatility, 30-day volatility over a historic 10-year period. And what it basically suggests very simply is that oil volatility is at an extreme low, and that hasn't happened in 10 years, so it's a 10-year extreme low. What I've overlaid on this chart is an intermediate cycle that basically suggests every 2 years there tends to be a spike, 2 years or so, in the oil volatility and of course price itself. So we're overdue in terms of the historic extremes that we're in. There's a potential probability for an upside mean reversion, but also in terms of the cycle, the intermediate cycle, it also suggests that we might get a big move in oil or a price spike in oil of up to 1 standard deviation according to this chart.
Okay. Now, people are kind of a little bit concerned that it's going to be similar to the Arab Spring situation, but in terms of whether or not that's been priced in or different things like that is also causing concern. What are your thoughts on this sort of side of things?
Well, technically, one of the best proxies that we can look at, just to get a gauge of some of the risk premium being priced into oil, is to look at the contract performance between West Texas, the American proxy oil contract, and Brent crude, which is the European version, which is highly correlated to the Middle East and Africa region. So generally, in high risk or growing geopolitical tensions, Egypt in this case in point, but of course there could be ramifications across the region. If you think of neighboring Israel, which is I think just a point in terms of border control and whatnot, the Suez Canal in Egypt, neighboring Syria and whatnot, so that there's a whole melting pot. And what I've said is basically the Arab Spring region is still very fragile, so that's something that everyone should keep in mind. But the bottom line is any type of increased attention during that fragile, within that fragile region, should pop up on this chart.
Okay.
And basically, we should start to see Brent crude prices become more expensive relative to West Texas because of that risk premium. And if we look here, we can see that for the duration of this year, the exact opposite has happened. Brent crude has traded much cheaper than West Texas. But what's interesting now is that we are hitting a key support area around $4 to $5, which is the spread difference between the two contracts. And at this moment, I I'm looking for potential consolidation around that area. If we then experience a bounce from oversold areas back above the $10 mark, then that would suggest a move back to the Arab Spring top that I've just highlighted there in the red circle, roughly above the $25 mark.
Okay, so we're looking for some potential support there. But in terms of one aspect which I think is always on everyone's mind is the VIX factor, if we can put it as that. But there is still, obviously, creates some concern over the coming months, especially over the summer. But there's still room for opportunity there. Is that correct?
Yeah, it is. I mean, it's some of the news that we're discussing, or the trade ideas, seems to slant on the negative side. But I mean, there are ways to position oneself to take advantage, if I can say that, of the event risk or potential moves in the market. One of the best things to do is of course, trade volatility itself. It's a great way to avoid getting it wrong on the actual price chart in terms of the directional move and the timing. When you're buying a volatility contract, you can buy it across a certain time period. I would suggest 6 months plus, 6 to 12 months maybe, so that we can offer enough duration for you to play out this trade. And of course, everyone's favorite volatility index is the VIX index based on the S&P 500. And this is just basically a measure of fear sentiment in the market. And as most of your viewers probably already know, we've been at historic lows, suggesting that most investors and traders have been very comfortable, despite some of the tail risks that we've experienced.
Yes.
And as of about a week or two, we had a move above the 20% mark on the VIX.
That's all important. 20% market is quite poignant, isn't it?
It is, and partly because it's a big number, psychological number, and it's the first time that we actually moved above 20% this year. So you have that time factor. But more specifically, if you take a step back and look at the chart, there's this long-term, multi-month breakout pattern which was activated when we had that move above 20%. Now, of course, the move, the VIX has moved lower again, so we have to wait for that confirmation one more time. But keep in mind that once we do have that confirmation, if and when we do, and I think we do into July and August, it may likely strike a historical parallel with what we saw last year, and you can see their history repeating itself, where you had a consolidation, the VIX was at historic lows, and then you had this massive spike during the summer months.
Certainly one for looking out for. But Ron, thank you very much for coming, and you've given us a lot of insight, a lot of tips, I'm sure, for our audience. Now, before you go, we're not finished with you yet. We're going to ask you to take part in our Dukascopy question, namely, if you had $1 million to invest for 1 year. I know it's a dream. If we had $1 million to invest for 1 year, which asset class would you choose to invest in? If we look at the board, real estate, equity, bonds, gold, cash and oil. So we've been talking about oil, but where would you choose to put your money in for 1 year?
Well, it's a challenging question, especially because 1 year is quite a big time frame during these days. It would be a choice between cash over the long term, but actually if I was to choose between each of those in terms of the next 6 months to 12 months, it would be gold. Gold,
that's an interesting choice at the current levels that we're seeing. Why so?
Well, as everyone already knows, extremely undervalued after the big, I think almost 30% drawdown from record highs. My cycle work is suggesting that this is a big painful move, which is setting up the next long-term push up back into $2,000 and above $2,000. I think it'll maybe once we start to see increased volatility in the market, that some of the potential trades that start to show themselves again is gold, in terms of it really becoming a safe haven trade, as it has been for many years, and also markets like the US dollar and whatnot that might start to have some upside momentum.
Well, Ron, thank you so much. A lot of great insider's knowledge. Thank you for sharing it with us today. It's been a pleasure.
Thank you very much.
Thank you. Well, that's all from Ron and myself for the moment. Click back to Dukascopy TV for today's Commodities Corner. Goodbye for now.